QuickBooks Pro Desktop 2021. Multiple currencies, receive payment, and make deposit with the help and use of Excel. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our multiple currency practice file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In prior presentations, we set up our QuickBooks file. We turned on the multiple currencies by going to the edit dropdown, the preferences, then the multiple currency, the company preferences tab. We then turned on the multiple currencies, noting that as we do so, we cannot turn it off in the current file. Therefore, we set up the practice file, which I would recommend doing if you're testing out the use of the multiple currencies. Closing this back out, we then set up an invoice. So I'm going to open up the invoice here. Going to go back to the prior invoice we set up. We had the customer that we had to add. We added the customer as someone who pays us in a foreign currency, in this case Canadian dollars, even though we keep our books in US dollars. That then created the receivable that's going to a Canadian receivable, which is going to help us to do our adjustment from the foreign currency to the US currency using the spot rates that we can then generate within the QuickBooks system. So this then increased the accounts receivable, the other side going to sales. Let's take a look at that. We're going to close this back out, opening up our reports drop down, company and financial. Take a look at let's look at the balance sheet first. Balance sheet standard. We're going to go to the customized reports up top, changing the dates from 01/01/21 to 12/31/21, January through December 2021, and OK. So here is our information. There is our receivable. If we double click on that, we will then see the invoice that we created, meaning we created the invoice. And then even though we expect to receive foreign currency, we recorded it on our books at the equivalent US dollars using the spot rate at the point in time the invoice was created, which in this case was 3/30/21. We then made an adjusting entry as of 5/30, which we might do at the end of the month in order to make our kind of month-end adjustments to adjust the balance to what the spot rate currently is. And so we had an increase for that adjustment here. So then if I close that back out, go to the reports, go to the company and financial, take a look at the profit and loss standard, changing the dates from 01/01/21 to 12/31/21. We then have the sale that was on the books. That's the original invoice, converting to US dollars at the point of sale, the spot rate at the point of sale. Then we had the adjustment. When we recorded the adjustment, it recorded the gain, not to the sales line item. We didn't adjust the sales line item, which we recorded at the point of sale at the time we made the invoice, but rather created another gain item down here in this case, other expenses. So it's a negative expense or a gain. So if I go to the home page now, let's take a look at what this looks like in terms of our flow. We have the invoice, and typically what happens after the invoice is we receive a payment. So, and notice if we didn't do that interim step, then QuickBooks would give us a system to do that fairly nicely, meaning we made the invoice using the spot rate to convert to Canadian dollars and the US equivalent with the invoice. And then when we do the receive payment, QuickBooks will then generally record the adjustment for us for the change in the spot rate between the two automatically. The fact that we entered an adjusting entry in the middle, as would often be done at the end of the month or the end of the year, if it goes through over the cutoff period, is going to mean that we're going to double up that adjustment. That adjustment will be doubled up, and therefore, for QuickBooks purposes, we would typically want to reverse, meaning that adjusting entry that we had to adjust the accounts receivable, we may then want to have a reversing entry right after or in the following month. So we'll see that in the next couple presentations, what that looks like. Let's just think of it now in Excel. In Excel, what we did, just so we can see it clearly and transparently, we had the accounts receivable increase here for 27/3. That was because we're going to receive $42,000 Canadian dollars in the future, and we used the spot rate, the current spot rate, to record it on the books in US dollars. So we're going to be receiving 27,300 US dollar equivalent of the actual units we're going to receive, Canadian units of $42,000. Then we recorded the increase with a journal entry, increasing the accounts receivable, the other side going to the gain on the trial balance at that point in time. So the next step then is that we're going to record the fact that we are receiving the money. And now we're going to receive $42,000 Canadian dollars. But once again, we need to record that receipt in the US equivalent at this point in time. So we're using the same second exchange rate here. So we're saying this happened at the same time. So we converted, in other words, the receivable to the current value, the current equivalent value as of 5/30. Now we're going to record the fact that we're receiving the money. So we're receiving the money. The only kind of change here is that it's not going into the checking account, our normal cash account. It's going into another account, which is going to be our foreign currency units. Now, the foreign currency units in QuickBooks will basically be set up as a checking account because we are holding on to cash, but it's not the kind of account that we measure our books in because we're holding foreign currency units in that cash account. So although it's cash, we still kind of think of it as you might think of like a investment in stocks or something like that, which we're going to have to revalue, taking the units that are in there in foreign currency and valuing them in US dollars using the current exchange rate. So we're going to say, all right, there's the currency that we're going to be getting. We're going to be using the current exchange rate, which is the 68 at this point. So this is going to be equal to the 42,000 units of foreign currency, Canadian dollars, times the current exchange rate, 0.68. That's going to be the 28,560, which of course matches what we currently have in the accounts receivable. That's why we did this adjustment here in the accounts receivable. So then we're going to increase those units and we're going to take them out of the receivable. So they're going to be decreasing the receivable. And that's going to be for the same amount. So if we record this out then, we're going to say cash is going to go up. In QuickBooks, it'll be the actual checking account, a checking account for cash, but it will be in foreign currency units, is going to go up for not the 42,000 Canadian units, but the equivalent of 28,560 for our bookkeeping purposes. Then the other side is going to go down, that being the accounts receivable here. So we're going to double click on the receivable. I'm going to say plus. We're going to be picking up that 28,560. That will then decrease this amount down then to 0, and that then puts us back in balance. So this process, then we want to do the same thing over in QuickBooks, which can actually be a little bit more difficult because again, when we record the receive payment, it's going to kind of record the transaction or the adjustment automatically already, which we already recorded. So we could have a double up and we'll have to do a reversing transaction. For example, this transaction we did will actually be basically reversed, right? We'll have to reverse that. And when we put money into the received payment, it will usually increase undeposited funds, which we would then need to then deposit. And obviously we're not doing that over here in this account. We just recorded it directly into the foreign currency, which is like the checking account. You could make it so the received payment goes directly into the checking account by adjusting the settings, and then have it go directly to the checking account with this item here. Also, when we do this, of course, we will have to make the adjustments to we would need to make an adjustment to the current exchange rate, which we would do in the lists drop down. We would then go into the currency lists, and then for the Canadian dollars, the current exchange rates, we want to have those set up before we do the receive payments. And we would just basically say download the latest exchange rates. We will obviously be manually inputting in those items because we're working in the future.